Just a little bit on my background. I spent about 25 years on Wall Street, primarily in equity capital markets, doing global macro analysis and technical analysis. I worked with Bob Farrell at Merrill Lynch. I worked with Luis Yamada at Citigroup for a while, and even Carter Worth for a little while at Oppenheimer. I then went to the buy side about 10 years ago, where I worked with a longtime client, Steve Leuthold at the Leuthold Group. After Steve retired, I was managing director of Global Macro Strategy, where I worked with Jim Paulson and Doug Ramsey, who are two very good friends of mine, and I keep in touch with and follow their work pretty closely. I've been on my own for about 4 years now when I launched my own family office in 2018. And we sort of accidentally launched an investment strategy publication called Alpha Insights, which you're kind of seeing the headline cover of today. And so most of the work that we publish and distribute out to our institutional client base goes on by the moniker Alpha Insights. And so we do 2 publications, a monthly called Review and Outlook, where we basically publish a 100-page document looking at the capital markets around the world, everything from U.S. markets, sectors, and equities specific, global markets. We have a long-short portfolio that we work with a lot of hedge funds on, and we do a lot of macro perspectives. We look at everything from commodities, cryptocurrencies, and rates. And then we also publish another publication called Weekly Playbook, where we basically give our updated market analysis and top actionable ideas every single week to our subscribers and client base. So today what I'd like to do is talk to you guys a little bit about what we think is going on in the economy, how it affects the markets, and how geopolitics fits into this in the end. I've got about 20 slides and 30 minutes to present. We could have a 30-minute Q&A on each one of these slides. So I'm going to ask you if you could kindly hold your questions to the end, and I'm going to try and blast through this deck in 20 minutes, and we'll spend about 10 minutes on Q&A. So let's kick off by just saying that the title of this presentation is Winter is Coming, and it may arrive by fall. I want to start with a quote here. It's a rather famous quote from Milton Friedman. Inflation is always and everywhere a monetary phenomenon, in the sense that it is and can be produced only by a more rapid increase in the quantity of money than output. And I think that is probably the most germane concept in the capital markets today, because we've certainly seen a more rapid increase in the quantity of money than we have seen in output over the last 24 months. And so with that, let's take a quick look at what's happening in inflation. And, is inflation peaking? That's the question on everybody's mind right now. What we're looking at is the dashboard for core inflation. This is published by the Atlanta Fed every single month. Actually, they update it weekly. And the most recent update shows that core inflation is measured by the 9 Federal Reserve banks, and more specifically, the Cleveland, Dallas, San Francisco, and Atlanta Federal Reserve banks, that each have kind of produced a cadre of calculations that look at core inflation from a different sort of lens than the CPI would present. And of course, the Board of Governors themselves have adopted this metric of core PCE, personal consumption expenditure, right? And so that eliminates things like commodity prices, the price of oil, the price of agricultural goods, things of that nature, and focuses really on those measures that are a little bit more sticky and present regularly, right? And so core PCE actually ticked down recently from 5.2% in April to about 4.9%. I'm sorry, March, and then to 4.9% in April. And I think, if the Fed is really looking at 4.9% as a measure of where core inflation is today, and their neutral rate on Fed funds is being something around, 2%, I think they're sadly mistaken. At the end of the day, they're a good 270, maybe 290 basis points off the mark in terms of where they believe neutral is on the Fed funds rate. And I think that the market is going to tell them that in no uncertain terms. But if inflation is peaking, then I think we need to beware. And what we're looking at here is a chart of the consumer price index on a year percentage change from a year ago level. And what you'll see on the far right of this chart is the most recent ratings, which have come in around 8.3% recently. We'll get another report on Friday. The consensus is looking at something like 8.2%. And the real question is, are we peaking? You know, has inflation peaked? A lot of people would argue yes. A lot of people would say that the rate of change just isn't going to go higher than it is now. Well, if that's the case, beware, because since the early 1960s, every single peak in inflation has been followed by a recession, some worse than others. You know, the current peak in inflation is actually the largest in absolute terms on a historical basis, and the third largest in percentage change terms following the 81 and 74 peaks. Now, recall that those two peaks in inflation were followed by severe recessions. And in fact, those recessions are widely regarded as the worst recessions since the Great Depression. So let's think about monetary policy here. Monetary policy, as it's been articulated to us by Powell and company at the Federal Reserve Board, is poised to tighten. There's no question about this. The Federal Reserve has told us in no uncertain terms what they're going to do. On June 15th, they are going to raise the Fed funds rate by another 50 basis points. They've stated that. They've sent every dove on the panel out to reconfirm it. And we should expect fully, as the street does, to a 97% probability that the Fed will raise rates by 50 basis points on June 15th. They've also said that they're going to raise them by another 50 basis points in July, and then potentially pause in September. Well, right now, if we look to the right-hand side of this chart, it's the dot plot. And the first column of those dots centers around a level of about 1.875 midpoint. So that's 1 3/4 to 2% range for the Fed funds rate by the end of this year. That means that the Fed is looking to raise the Fed funds rate by another 100 basis points before year end. That is the consensus view based on the dots. Those are the blue dots. The red dot, on the other hand, expresses how the market perceives this. And that is the market's view based on the Fed funds futures curve at this point. And the Fed funds futures curve is actually pricing in 175 basis points of tightening before year end. That means that, you know, the Fed and the market are 75 basis points apart. And if the market's right, we're going to see a Fed funds rate that's somewhere between 2.5 and 2 3/4% by year end, and probably going higher next year. So what does this do to the economy that is already an economy that's already experiencing a deterioration in growth? First quarter GDP, real GDP, declined by 1.5%. That missed the mark by a country mile based on versus expectations. And that compares to a 7% annualized rate in the fourth quarter of 2021. Now, according to the Atlanta Fed's GDP nowcast, real GDP growth remains very weak, and it's actually been trending below 1% on an annualized basis for the second quarter. It got down to near zero before we got a positive data point last week. Now, the question is, what's going to happen between now and quarter's end? If that GDP forecast dips below zero, that will be the second consecutive negative quarter of GDP. As a rule of thumb, we can look at that as a guideline to recession. But that's not all, folks. Today, we heard from the top CFOs in the United States of America, okay, responding to a CNBC poll that found 77% of those CFOs in Fortune 500 companies now believe that the US will fully be in recession by the first quarter of 2023. So it's not really my opinion. It's not even the data, and it's not even rule of thumbs, but the people that have their hands on the tiller at this point know that the economy is headed to a recession. Now, my question is, are we already in a recession? I think it's something of a rolling recession. We've seen it show up in hard goods markets. We've seen earnings estimate revisions from Target most recently. They bought all the wrong inventory. Consumers are spending on experiences now instead of hard goods. Maybe that's just kind of a ripple through the economy, but maybe it's really a rolling recession that hasn't quite gripped onto every sector of the economy simultaneously just yet, but that may be coming. We're looking at this chart as a very, very long-term cycle of economic momentum, okay? What we've done is we looked back at 110 years of data of the most cyclical sector of the US economy, transportation. And what we did is we took the Dow Jones Transportation Average Price data and we detrended it. And this is what we got. We got a very obvious cycle where we've seen really from trough to trough about 34-year periodicity. And those who know anything about numbers know that that's an important number. It's a Fibonacci number. Fibonacci 34-year cycle is an important repeating, recurring cycle in the last century's history in the US economy. And what we had expected coming into this year is that at some point this year, it appeared that that structural momentum of the long-term economic cycle was poised to peak this year and roll over. And we've already seen the cycle turn down and break below the long-term regression mean. Now, if in fact we have seen the peak of this cycle as we expected to this year, then we should look forward to a 17-year period where structural momentum of the long-term economic cycle is poised to the downside. And we should not expect that structural momentum, downside momentum, to abate until about the year 2039. So a lot of people have been talking about this pullback in the market as a buying opportunity of a lifetime. We saw this big 35% correction in the S&P 500 during the COVID crash, right? And people that held their ground and didn't sell their stocks and listened to their financial advisors did just fine. Months later, the market came back, recovered 100%, and subsequently rallied dramatically off of those lows, effectively more than doubling the market from the lows. The question is that going to repeat from these levels? Well, we did a very long-term valuation study looking back at the S&P 500 from about 1925 to present. And what we did is we marked significant historic lows that have never been seen again since they occurred, and that makes them significant. And then we've also marked the significant highs of the market, those that were epic market peaks that marked levels that weren't recovered from for almost 20 years or more in some cases. On the tops, we saw the 1929 peak at 32.5 times on a cyclically adjusted PE ratio. This is the well-known Shiller-Cape ratio, which adjusts all the data for inflation and normalizes margins over a 10-year period. And so we think that there's no better time, right, than now to look at the market on a cyclically adjusted basis, considering where we are in terms of profit margins at historic highs. We're over 13% right now, and inflation at a 40-year high. And so we want to inflation adjust everything and normalize everything. And when we look at the past peaks, they were 32.5 times in 29, 44.2 times in 2000, and most recently in January of 2022, 38.6 times. However, when we go back and look at the historic lows, be it the 1932 low or the 37 low or the 42 low or the 74 low or the 82 low, those lows were predominantly mid to high single digit CAPE ratios. It wasn't until 1987 that we started to see the lows show up in the teens. The 87 crash low was 13.3. The 2009 low was 13.3. And the next jump up was the COVID crash low. The March 2020 low came in just below 20 at 19.8 times. Those so far have been historic lows that have heretofore not been seen again. Yet the pullback to the May 20th low bottomed at a CAPE ratio of 31.0. Now, if in fact that was a historic low, a low like we saw in 2009 or 1987, then why is the CAPE ratio more representative of an epic market top like that which we saw in September of 1929 than a mid or low teens PE like that which we saw in 1987 or 2009, or even a high teens PE like that which we saw in March of 2020? I think the answer to that is because it is not a historic market low. It is not a buying opportunity in a lifetime. And I'm going to explain to you why that is the case. Let's first look at earnings revisions breadth. It's turned negative. What is earnings revisions breadth? For those of you who aren't following these, minutia of the market like this, it's the difference between the number of companies that are seeing earnings revisions to the upside versus earnings revisions to the downside. So that spread, that represents the breadth of earnings revisions, and it just turned negative. That means that corporate earnings expectations, okay, and that's not saying earnings themselves. Earnings themselves are way worse than corporate expectations are. In fact, first quarter earnings missed expectations by 50%. I mean, the street was looking for 9.3% earnings growth in the first quarter, and we actually reported 4.7%, actually down 12.5% versus the fourth quarter. So a sequential decline and just a mid-single digit year over year gain. Now the street's still looking for 9% earnings growth this year and next year. All they did is they took that earnings miss and they pushed it out into the back half of the year. And I'm here to tell you that current earnings estimates on the street of about 228, we won't see those this year. We may never see those. Those estimates are too high and they are coming down. And we're starting to see this show up in this earnings revisions data right now. I think that this negative earnings revisions breadth figure is a big sign of trouble for the market in the balance of the year. Investor sentiment. Everybody's talking about how investor sentiment has never been more bearish than it is now. If we look at the AAII sentiment survey or the Institutional Investor Advisors survey or the Name Exposure Index or the University of Michigan Consumer Sentiment Index or the CNN Fear and Greed Index, name your index, whatever you prefer to look at as your favorite gauge of investor sentiment, they are all or have recently been near record lows. And as a result, everybody believes that signals a market bottom. The problem is, historically, if we look back over the last 30 years or so that this data has existed, we can see that asset allocation exposures, in other words, equity positioning, has tended to be coincident with sentiment survey data. And we've just overlaid here the University of Michigan consumer sentiment data with the AAII asset allocation to equities data. This chart was put together by Callum Thomas of Top Down Charts. Thank you, Callum. He's done a great job with this. But through the end of May, what we saw is that investors, despite as bearish as they've said that they are in the surveys, are still positioned near fully invested with 67% equity allocations today. Now, this degree of positioning is absolutely inconsistent with past market bottoms. In fact, if market conditions and economic conditions worsen as we expect they will, then we think that this juxtaposition between attitudes and actions is likely to witness a very rapid convergence, and that convergence will likely be to the downside. That gold line, which represents the asset allocation, will meet the blue line, which represents the attitudes of investors, down there somewhere in that 40 to 45% range. Let's look at the stock market itself versus the Fed's balance sheet. This is something that we've dubbed stock market inflation. Over the history of the Fed growing their balance sheet, which is represented by the green line in this chart, a chart that was put together by Tom McClellan, the proprietor and founder of McClellan Oscillator. Tom does a great job with his data analysis and fitting this data perfectly. And what it shows is that the market has been very responsive to the Fed's quantitative easing. QE1, QE2, QE3 all resulted in big responses in equity prices following directionally with a very high correlation to that QE. But when we did see QE tail off, we did see the market tail off as well. However, in March of 2020, we then saw the Fed basically respond with almost an epic QE. QE4 was more sizable than the first three editions. In fact, it took the Fed's balance sheet from $4 trillion to nearly $5 trillion at its peak. But what we noted is that the correlation between equity prices and the Fed's balance sheet became so close, it was nearly perfect. It was 9.98 was the R squared. And that tight correlation seems to me could potentially be just as tight in reverse as the Fed starts to draw down their balance sheet, which they did beginning on June 1st. In fact, the Fed laid out their plan at the May FOMC meeting, and that plan is to draw down $402.5 billion, or 4.5% of the balance sheet, by just letting bonds run off, letting them mature and not reinvesting the money, letting it go back to investors. And that runoff into year end may very well have already been reflected in stock prices today. It's next year that I'm worried about. Based on the plan as laid out, the Fed will then allow another 1.14 trillion in securities to mature and roll off the balance sheet. That's another 13.3% in 2023, and it should be about the same amount every year thereafter unless they change the plan. Well, based on the glide path of equities today and that historic relationship, our suspicion is that as the balance sheet runs back off down to its pre-COVID levels, the prices of equities could follow in lockstep. And we would target a level of around 2250 on the S&P based purely on this analysis. But here's something else that I don't think should be ignored, and that is that because the Fed is trying to attack inflation through balance sheet runoff and raising interest rates, we're seeing the cost of servicing a mortgage go up by a level that we haven't seen in quite some time. In fact, if we look back just 15 months to March of last year, the cost of servicing a mortgage on the average house in the United States was $10,000 a year. Today, it's $24,000. And that's just because mortgage rates went up from 2.5% to 5.5%. This chart that was put together by Francois Trehan shows with the orange line, the S&P 500's year-over-year change in value, price change. The blue line shows really the annual mortgage cost, and it's inverted. So what we're seeing is when mortgage costs are going up, the blue line is going down because of its inversion, but that's fitted to the S&P. And if we look to the right-hand side of this chart, we can see that there's about a 9 to 12 month lag in stock prices versus that change in mortgage costs. And what Francois's presentation here suggests is that over the next 9 months, there could be a dramatic catch-up between the relationship between these two variables, which have historically had a better than 90% correlation with a 9 to 12 month lag. So 140% increase in annual mortgage service is going to have a negative impact on equity prices next year. So let's look at what's happening here. I just lost my, oops, okay. So let's look at the momentum of the market. This is a chart looking back to about 1986. And we're looking at monthly data for the S&P 500 on the top. This is closing price data and a 36-month moving average. The bottom chart shows 36-month momentum, okay? So the upside and downside deviations relative to that moving average. This long-term relationship is probably the best long-term momentum study I've ever seen, and it's highly predictive. Many of you may or may not know that there's a persistent 7-year cycle to the stock market. It dates back to about 1910 with the Dow and 1926 with the S&P data. And it actually dates all the way back 6,000 years ago to the ancient Jewish Shemitah cycle. And so if we fast forward that to the last century and just true up that 7-year cycle and bring it into the last 4 decades, we can see that there's a very persistent 7-year cycle where momentum bottoms and then rallies, bottoms, then rallies, bottoms, and rallies. But what we see before the 7th year of that cycle is we see a major momentum divergence. And that's exactly what we saw coming into the 7th year of the current cycle, which is slated to bottom in the 4th quarter of this year, plus or minus a quarter. So it could bottom anywhere from, say, September 30th to March 31st of next year. And in our view, this is going to be a doozy because we had such a parabolic move to the upside and such a obvious negative divergence in that momentum study. And the collapse in momentum has been fairly persistent. It hasn't abated at all since the January top in prices. And so our suspicion is we're going to continue to see prices and the momentum of prices accelerate to the downside until we see a low sometime in the 4th quarter of this year, which is why, as I pointed out, the title of this presentation is Winter is Coming, but it could come as early as this fall. And that's what I would be looking for a bottom in price action.
Hey, Jeff. So we actually consumed the 25 minutes. I'm giving you another 15 because I'm anticipating a lot of questions. But
sure,
I think if you can wrap up the deck in 5 minutes, that'd be great.
I got 5 charts to show you. That's
Q&A.
perfect.
Yep.
Okay, boom. We're going to start here with just the S&P 500. Looking at the last 3 years, this is a weekly range. We see a major top formation developing here. This is a classic pattern top formation of the head and shoulders variety, something market technicians have been talking about, ad nauseum since, I think the days of Charles Dow. And the breakdown that we saw below the October 2021 lows and, the breakdown below 4,100 on the S&P confirms that this is already resolved to the downside. And that projection should carry prices all the way down to about 3,500 based on its measured move count. But that happens to be where we see kind of a coalescence of support. This would include the 50% retracement level of the advance off the March 2020 low. It would include the 200-week simple moving average, and it would include 2 important weekly highs that occurred in November and August of 2020 that marked a range area in around the 3,500 space. So our target from a pure technical perspective is 3,500. However, if we dig just a little bit deeper and look at this from a behavioral perspective using Elliott wave analysis, and we go all the way back to the March 2009 low, we see that we've completed what I would describe as a cycle wave advance, 5 waves up at cycle degree. And the final wave of which, primary wave 5, was off the March 2020 low. That looks to have terminated right at the top of a parallel trend channel and has turned down sharply as we just illustrated in the prior chart. What we didn't illustrate is how far that price action needs to go in order to correct a cycle degree advance. And it needs to go somewhere between 38.2% and 61.8% in order to be kind of a textbook correction. That would take us down to at least 2250 and potentially, or at least 3200 at the 38.2% retracement and potentially 2250 at the 61.8% retracement. Now, one thing that we just put out there for people to entertain is whether or not the cycle degree top is part of an even bigger formation. And we call it a super cycle wave top. We're calling it wave 3 because the only count that we can come up with is off the 29 high, which is wave 1, and the 32 low, which would have been super cycle wave 2, everything off of that low was super cycle wave 3, the way we're counting it. And if in fact such a thing as a super cycle actually does exist and no one knows for sure, it's just theoretical because no one's ever seen one because we don't have the data to go back that far. Some people have tried to knit together price action from the 1800s and, you know, with the old railroad stocks and taking it all the way back to the London Stock Exchange. And I just don't think that that's something that we can do with confidence, but it's good for theory, right? And so we're looking at this theoretically as potentially being part of a much bigger corrective action, which could carry the market substantially lower than we've already articulated. Under the rubric of this concept, we could see prices go all the way back to the 2000 highs of around 1500, 1550 on the S&P, or potentially to the 2009 lows, which would just bring the market back into sync with its very, very long-term trend off the 32, 37, and 74 lows. Hypothetically, the lower boundary of an advancing trend channel. But I don't want to get too much into that because, I think that that's more theoretical and it's a conversation for a later date that if we start to head dramatically lower than I've already, outlined, then something like that may very well be in place. But what do you do right now is the real question. And, we put this chart together, which is a relative rotation graph of the 11 GIC sectors in the S&P 500. And we've titled it Nowhere to Run, Nowhere to Hide for a reason, because every single sector, with the exception of energy and utilities, is now trading below its 200-day moving average. And every single sector, with the slight exception of energy, is actually in a downtrend right now. Utilities to a lesser extent, but everything else to a much greater extent. And, it looks like energy's turning back up with Exxon and some of the big names making new highs yesterday. And I think I printed this chart out at the end of last week. So, energy is a potential place to hide, but it's dependent on energy prices. And if they remain elevated at $120 a barrel, then we could very well see energy stocks continue to do well. Utilities will probably fall into the same camp. They pay nice dividends, and they've always been historically a safe place to hide. Possibly healthcare and staples, but those are being affected by the broader impact of inflation, and I wouldn't bet the farm on those two sectors. One area that might actually be a great place to hide would be long short strategies. We've looked at long value short growth for some time now, going back about 6-7 months. We started highlighting this as a place to position portfolios to mitigate what's happening in growth stocks. And what we're seeing is a great degree of vulnerability in the top 10 names in the S&P 500, which are Apple, Microsoft, et cetera. As these stocks have broken down dramatically and appear poised to break down even further, we think value stocks will continue to do well. And there's a strong correlation between this long value short growth and rising interest rates. And we think rates are poised to continue to go higher. So what could potentially be a catalyst for these kind of worst case outcomes that we've laid out here? Well, one that a lot of people haven't been focusing on is geopolitical risks. And the reason that they're not focusing on them is because if we look at the Fed's geopolitical risk index, it really says that the risks are behind us. We saw this big spike up when Russia invaded the Ukraine. It was the highest level we saw since the London bombings in 2005. But now we've just pulled back into the range, closer to the high end than the low end. But the problem with all of this is the data inputs that go into this index are largely coincident indicators. With the exception of stock prices themselves, all of them are. And so it's not a predictive model. It's basically more of a history lesson of what happened. What I think investors are really missing, if they're not focusing on this, is what is going on in China right now. And we saw a great article in the Wall Street Journal that came out weeks ago, back on May 20th, actually, that talked about how China may be preparing for war, and that China actually has implemented kind of their new national foreign asset and investment law that would give them the ability, under special circumstances, which include war, to nationalize all foreign investments. And this would give them the ability to basically take all the capital that has been poured into China and take ownership of it, much the way we have done to Russian oligarchs. The other thing that the Chinese have been doing is they have been hoarding grains and building up their strategic petroleum reserves. As of February 4th, China, with just 20% of the population of the world, currently hoards about 70% of the world's corn, 60% of the world's rice, and 50% of the world's wheat supplies right now. You generally don't do something like that unless you're planning to be locked down for at least 2 to 3 years, and that's about a 2.5-year supply for them. Keep in mind, China has always wanted to bring Taiwan back under the umbrella of China, much the way they did with Hong Kong a couple years back. The difference here is that Hong Kong was always part of China. One China, two systems, right? They did violate the agreement by bringing them back in early, and they did that through force, if you recall. Now, Taiwan is not part of China. It maybe once was 200 years ago, but Taiwan is its own sovereign state. And to invade another sovereign state and basically take it over is an act of war. And the reason that we think that these motivations by China should not be underestimated is this: he who controls the supply of semiconductors controls the world. And the outcome of these geopolitical maneuverings is world economic dominance. Right now, Taiwan provides 70% of the world's chip supply and 92% of the world's most advanced sub-nano degree manufacturing capacity. And that is very difficult to replicate and actually requires the machines in Taiwan to build more machines that create that sort of low nano technology in terms of semiconductor production. So, we think that these issues could potentially be a catalyst for something that could occur perhaps as early as later this year. And with that, I'll turn it back over to you, Marty, for questions.
I guess we had a question from Dan Kern about TCN, which is I don't even know what is TCN, Dan? It predicts a single family home crash.
Never heard of it.
Okay, well, we'll move on to the next thing. So, first of all, questions from the audience here. Any questions? Because I mean, so. First of all, Jeff, let me just tell you, this is like a tour de force of economics, right? And everybody's shaking their head yes. But my first comment, I would typically use a sports analogy saying that this is like Michael Jordan shooting a three-pointer to win the series against the Utah Jazz. But actually, I'm going to say that it's more like a Steph Curry shot because I'm in San Francisco today. So really fantastic. Great job. Any questions from the audience about? Okay, yeah, so, Jeff. Sorry.
Yeah. So Robert Levin.
Robert.
Quick question. I didn't see any charts on leverage, and if you could talk about the role of leverage. I know that in Africa we have more leverage now than we had in 07-08. So on the way down, doesn't that accelerate long liquidation?
So yeah. So the question is overextension of leverage, personal and corporate. Yeah.
I 100% agree with you. I think it's one of the biggest problems. I talked about it at length in my last presentation for this group. I didn't want to be completely redundant. Nothing's really changed. We've got something like 300 trillion in global debt, maybe a little bit more by now, but as you well know, it's multiples of GDP, and as a result, liquidation of that debt would have a catastrophic impact on equity prices because, one man's debt is another man's asset. It's an asset liability swap. And so, one of the things that we've been talking about in our normal publication is the decline in the rate of change of margin debt. Margin debt's declined from a peak of 935 billion back in October of last year to 722 billion this year. But the rate of change actually peaked in March of 2021 at 71%. It's now negative 5%. Typically, when the rate of change goes negative, it is concomitant with a decline in asset prices, a drawdown in the S&P 500, if you will.
Okay, great. Other questions? You had a question? Yeah.
What is Jeff's desired outcome of this presentation? It's extraordinary. Is he looking to advise for folks, or how did?
Jeff, what's the purpose of the presentation? Are you an advisor to family offices, or
we are? Yeah, we advise family offices. We are a family office. We know how they think. We sell an institutional publication. You know, there's varying price points based on your level of service and, you know, number of people involved, that sort of thing. But, you know, we are definitely in the advisory capacity to family offices.
So Jeff, let me, I guess the comment on TCN is that they own thousands of homes for rent, and that there's suffering a massive decline right now, and that they're trying to get rid of these homes, these single family homes. But
yeah, that rings a bell now that you mention it, and that plays right into the debt liquidation side of things. And certainly it's going to be regionally market specific. You know, they're not going to operate in every single you know, of the 50 major metropolitan areas in the United States of America. But wherever they're dominant, it's going to have an impact if they specifically experience a liquidity event and are forced sellers and default on a bunch of mortgages. Then, you know, banks transcend geography. So whatever banks are servicing them, if it's Citibank or JP Morgan, that would be the thing to avoid.
So something that you didn't cover, and by the way, this is a fantastic analysis, but so many people have moved away from public markets into the privates, right? And you're not really covering exposure in private investment. And so, you know, one great story that we talked about yesterday was that there's a multi-billion-dollar hedge fund that invested in privates, and then they leveraged the private investment from JP Morgan and bought more private investment, and now all that is tanking. They're down 50%. You know, and you know, it's the old story about when the tide rolls out, you see who's got shorts on or not, right? So
Yes.
so you don't really have that analysis of the private market, and we'd love to see something like that in the future. And if you have any thoughts that you can opine about that, that would be great.
I would just say this: the private market's much smaller than the public market, obviously. However, it's also dependent on marks, and so it depends who's on the other side of your mark. You know, what desk is marking to market the valuations, and as desks get into trouble, those marks are going to start to show that stress. Okay, they're going to require collateral contributions and things like this, and so I think it's just another leg in the leverage stool. All private equity is another name for leveraged buyout.
And so you didn't also discuss, so there's a political aspect, which is the pension liability in this country, right? So there's trillions of dollars of pensions out there, of defined benefit pensions, and most of them have been suffering. So not only are they suffering because they have their stock market holdings have declined in general, but also because there is they started investing direct in privates, right? And so they're going to have needs, so pensions, endowments, to get liquidity. So you know, Mike, it's that whole, you know, domino story of forced selling, and, you know, having to liquidate assets to be able to get liquidity to be able to, you know, operate. Any thoughts?
Add to that the fact that will make them underfunded by definition, and add to that also that a large majority of pensions still have a 60-40 benchmark to stocks and bonds, and they're heavily invested in bonds, and bonds underperformed stocks for the first half of this year so far.
So I'm just going to end it right here, because we had a dinner party last night, and after dinner, besides Robert Levin giving us one of the greatest suggestions ever for a new venture, but I'll talk about that later. We had come to the conclusion that, you know, the world's becoming multipolar. People are moving back to a commodities-oriented, you know, economics. Any thoughts on commodities? Because you talked about energy, but you really didn't talk about, you know, the other parts of commodities. Yeah. You know, any thoughts on that?
I do. There's a new acronym I think we should all get used to. It's called the new FANGs. F is for fuel and energy. Okay. A is for agriculture. E is for aerospace and defense. N is for nuclear and renewable. And G is for gold and commodities. Those are the fangs that I want to be focused my attention on.
Nuclear and renewable. Works for me.